this is really puzzling. We know in Canada we have so many ETFs and cover call, and some of them they're just like the same type of ETF and cover call. But usually they come from different brokerage, or different fund managers. But at this time, we have three financial ETFs, covered call ETFs. They all come from one fund provider, who is Hamilton. Hamilton, a Canadian company that provides this type of ETF or manages this type of ETF, and they have three financials. And I've seen, or I've get some comments, people have saying, well, can you compare this and that? And I'm really appreciate those people who came forward, and they people who have put suggestions, into, okay, we want to see you compare this fund to this fund, because that will make, of course, your life easier once I compare, and we're going to see which out of these 3, 4, 5 ETFs are better for you to invest your money, rather than having the analysis paralysis, where you're going to have your money and you don't know where to invest your money, because there are so many options and you don't know where to go. So on this channel, what I do, actually, I do this with the data, of course, data that I have. This is real. This is not opinion. This is a real math. This is a real time data that I have that will provide performance and fees and everything, and we're gonna see which one. So I do this comparison all the time. So if you have any suggestion of what funds you want me to make comparison, please leave a comment below, and I'm going to do that for you. Again, if it's your first time watching this channel, please subscribe, hit the bell button so you can get notification. And if you're a subscriber, I really appreciate for you being part of our team. So without further ado, let's go to see these three ETF that I'm going to compare today. Today's video is a really great one. It's a really good. So stick around and watch. So today is going to be a really good one, because we are comparing between the two, which I call it triple headers, because today, I've compared two ETFs, two covered call ETFs before, and now I'm comparing actually three of them, which is HMAX, HCALL, and HFIN. These are almost popular covered call ETF from Hamilton, Hamilton ETF managers. So now let's start with HFIN. This will be our portfolio 1, this will be our portfolio 2, and this will be our portfolio 3 when we compare them. So what Hamilton Enhanced Canadian Financials ETF, or the ticker symbol is HFIN. A highlight of it, it's equal weighted portfolio of 12 Canadian largest financial services companies, yielding about 7% wealth monthly distribution, modest 25% cash leverage to enhance yield and return potential. Of course, this is selective Canadian Financial Equal Weight Index, TR 1.25, which is 1 and 25%. So 125%, because they do leverage of 25%, has outperformed the TSX Capped Financial Index. So capped index meaning is the bigger the company, the more the weight it has in that portfolio. But this one is equal weight. That's a highlight of the fund itself. When we come to a highlight of these two, you can watch other videos, which I've made a lot of video between the HMAX. So highlight of this is top performing Canadian bank ETF with 18% annualized total return. So total return meaning it has a performance of the dividends and including the performance of the fund itself, right? This is 18%. HCALL outperformed the average of the big 6 Canadian bank with a similar volatility, yield about 7%. When we come to this one, it's a 13% target yield, monthly distribution. And by the way, this HMAX is a brand new fund. Highest yielding financial ETF in Canada at the moment, right? Diversify exposure to 10 largest financial with approximately 75% exposure to big 6 banks. Active coverage. Active covered call strategy to enhance monthly income and reduce volatility. Current coverage is approximately 50%. So it does have a 50% of the fund is being used to do call, and the rest is being left to participate with the market. So that's a highlight when you come to a good fit for investor who wants to. So which which of these fund are they good for you? Who are they good fit for? We're looking at the person who is looking for higher monthly income, blue chip Canadian bank, tax efficiency, and reduced volatility. So it's pretty much all of them. They would have the same similarity when it comes to good fit for. Will be the person who is looking for more monthly passive income. When it comes to fund objective, now we can see some differences here. We look at the HFIN seek to replicate 1.25%, so 125% times multiple of selective Canadian financial equal weight index, because of course it's an index that follows, but it has 125%, right? So it has that 25% leverage, comprised of equal weights of 12 Canadian largest financial services. This does not include a bank. We'll see exposure of these big Canadian banks or financials, while adding modest 25% cash leverage to enhance growth potential yield. When it comes to this one, which is HCALL, we see the fund invests in HCA, because this fund actually invests in other funds, but we'll see exposure of this other fund down in a little bit, which is designed to closely track the return of selective Canadian bank main reverse index ETF. So you can see here there's a different strategy. This is a main reverse. You can go to Investopedia. You can see main reverse. What does it mean exactly? I'm not going to go deep into that, but this is different strategy. Invest in Canadian banks while adding modest 25% cash leverage provided by Canadian financial institution. Unlike other ETF that utilize leverage, HCALL does not use derivative. So derivative is a type of investment, or we call it's more. So you don't invest directly into a stock. You have more of agreement with a third party that you invest. They kind of replicate the return of that without having to actually have your money invest in that. So they say they don't do that with their strategy. So we can see between these two, there's obviously there's both they utilize that 25% leverage, but this one invests mainly in actually equal weight, and this one is not equal weight. When we come to HMAX, it's different breed. HMAX is designed to attract a monthly income while providing exposure to market cap weighted portfolio of Canadian financial services stocks to reduce volatility, augment dividend income. HMAX will employ an active covered call strategy. So they use active covered call strategy. HMAX does not use leverage. So we can see these two use leverage. This HMAX does not use leverage. That's the thing about these two. That's a difference we've seen there. If we go to performance now, and of course, let's skip the performance because we're going to go to another website with another data. I'm going to show you guys a performance. But if we look at just quick, the price, this will be about $16 because net asset value is $16.21, which is pretty much a reflective price. And this is $22 and this is $14, right? $14.20, $22.15, $16.21. Yield, we can see this is 761, this is 702, and this is 13%. And I've covered all these about these particular stocks. So when we come to the difference between these and the other cover call ETF or the banks, for example, this one, the yield about 13%. If we look at the Canadian bank on average, all of them are the cover call ETF yield about 7.81%, which is true. We can see this one and also the other from BMO, they all have look, 761, HCALL, HFIN is 7, but this one has 13% compared to any other Canadian cover call ETF. So this HMAX has the highest yield. When you come to what makes HMAX difference, we've covered this before, and then I have a video link below. But we can go really quick. This one actually right option on 50%, and of course the rest of the money stays participate with the market, so they don't invest, they don't use all the money to use a call. So that's a good thing. And HMAX of course does add the money, right? Highest monthly, it can provide this as highest monthly income because it does dynamic covered call strategy, currently writing call options on 50% of the portfolio at the money, right? That's a strategy they use at the money, and I've explained in another video. I'm gonna check the link below on this particular. I went on deep dive on this one, and HMAX allowed to generate highest option premium while maintaining 50% of upside potential, because this one, all of these ones actually participate full. This one does not participate full because it's only invested 50% of the money, and then 50% it leaves on the stock growth. So that's a pretty difference between these two. But when it comes to holdings, sector allocation, right, we can see this one has asset management is about 9, and has banks and has insurance. We can look at HFIN. It has asset management, it has banks and insurance. When we come to this one, HCALL, it doesn't have any insurance. It's only pretty much just banks, 6 banks. That's all. It doesn't have Manulife, and all the other stocks we can see here. So he has the Bank of Nova Scotia, Bank of Montreal, Canadian Imperial Bank, Royal Bank, Toronto TD Bank, and National Bank. When we come to HFIN, has all of those. Plus, it has Sun Life, it has Manulife, it has Great West Life, and it also has Power Corporation. Power is more of a management company, financial management company, and also it has Intact Insurance. So when we come to the funds, HMAX, it has all of these, except it doesn't have Power Corporation, and also it does not have, because these are 12 and these are 10. So it misses 2 out of this one. It doesn't have Great West Life, and also it does not have Power Corporation. So pretty much this has more of, I know of these two when it comes to stocks. But when it comes to management fees, inception date first. When it comes to inception, when were these funds incepted, right? We can look at this one here, was incepted in January 2022. So they were brand new, actually. When you look at this one, was October 14, 2020. So this is the oldest one, HCALL. And when we look at HMAX, it just came out actually literally just a week ago, January 20th. Strategy of investment, they all use covered call ETF. This one is called index-based mean reverse strategy, modest leverage. That's investment style. Investment style on this one is index-based. Of course, this is, as I say, these two, they use index-based type, but this one is active call. So they literally use, buy and sell. So this is more active. These are following index, but they're all covered call. When we look at the asset under management, this is right now is about 35 million, which is is going really well because it just is a brand new, right? When we look at this one, it has 410 million, and this one has 87 million. So of course, this has been in the market for a long time. That's why it has a lot of money in it. Current yield 761, current yield is 702, and current yield, this one we've seen, is about 13%. When you come to WAMADA's actual management ratio, this one has MER or management is about 65. This one has 65, and this one also has 65. When you come to risk, by the way, distribution is monthly. All of them, of course, all Hamilton, pretty much they do monthly. When it comes to risk rating, they all have medium risk, right? So they're pretty much all equal, medium to high. Actually, this one, medium to high. We can say this one is medium to high too, kind of, but this is medium to high. This is medium. This is also medium. Administrator, of course, Horizon Management, Horizon, and this one also has Horizon as a manager. So now when we let's look at performance, right? We go to performance of these. So I have a data here on performance. We look at the chart. This is a chart, using my subscription on Portfolio Visualize. I can see the I can go in the data back in the days. You look at from. So what I did here, I went through the bank themselves without having to use the ETFs themselves because they're brand new. So we can have the actual data for long term. So I went with actual stocks that they invest in, and I put, had I invest in these stocks, how much would it be? How much would each portfolio? We can see here, these are the ETFs, so now let's go at performance. If we look at the 1 year period, the portfolio 3, the way portfolio 1, 2, and 3. So 1 will be this will be HFIN, the 2 will be HCALL, and the third one will be HMAX. So if we look at the 1 year, HMAX is winner. The second one will be HFIN. When you look at 3 years, HMAX is a winner again, and the third one is HFIN. The second one is HFIN, and the second in the place, or the third in the place, will be HCALL. When we look at 5 years, when we look at the 10 years, so let's look at the 4. And this is just performance based. It has nothing to do with dividend that they pay. So end of the day, when we look at the performance, just performance, we look at HMAX actually has outperformed all of them. It's about 10%. And versus these guys has, the second one will be HFIN, about 9.74%. And when we look at HCALL is about 9.34%. So the winner out of these would be HMAX based on performance. But we're going to we are going on the scoreboard and see the full picture. So this series is called ETF Battle, of course, and then this is ETF Battle Scorecard, which is a triple header. We're comparing between the 3, HFIN, HCALL, and HMAX. So when we look at the risk, they're all medium, and strategy, of course, is cover call, and this is also a medium covered call, but this is active, and these are index based. When we look at the fees, they're all 65. So on those 2 points, they're all equal. So draw, we put there draw, meaning they're all equal. When we look at diversification, we are looking at HYLD. This is not HYLD. This is HMAX. Sorry. HMAX and HFIN, they are the winner because this one has 10 and this is 12. So there's not too much difference. But this guy here, it's a little bit lag behind. It's only 5. When we look at performance, we have 9 HFIN annualized over a period of 10-year period, right? We'll have 9 over 10-year period. Performance will be 934 over 9 10-year period of HMAX. Would have 10.98%. So HMAX here, of course, is a winner. When it comes to yield, they're all 761. They're pretty much the same, these two. When it comes to HMAX, it has about 13%. So this is our scorecard, and we look at HFIN has 3 points, and HCALL has 2 points. HMAX has 5 points. And the winner is... Should I let that you decide that, or should I just say HMAX is the winner based on what we have right now, right? So we get the winner here is HMAX. As always, if it's your first time, subscribe and let me know in the comment below what do you think. Was it a fair game comparison between these 3? And make a comment if you want me to compare any other funds that you like, that you want to invest in, but you're confused which one is the better. So let me know. If you have, there you have it. If you have any question or anything like that, just again, leave a comment. Bye-bye. Till we meet again.